Hello, everybody, and thank you for tuning in to the Liberty Report. Today, we're going to be talking about the Federal Reserve, that item that pops up just on a frequent occasion on the station. But we have a special guest to discuss the Federal Reserve with, and that is Paul-Martin Foss. And he was the legislative director for all my banking matters when we were in Congress. And he's coming to me today by way of Skype. He's coming from Virginia. Paul-Martin, welcome to our program.
Thank you, Dr. Paul. It's great to be here.
Good. Now, you since you left the congressional job and went out on your own, you started a new organization. It's called the Carl Menger Center. Just to refresh everybody's memory, exactly who Carl Menger was and what your center is and your website.
So Carl Menger was the founder of the Austrian School of Economics. He was the first generation Austrian, the guy who started it all. He was one of the three economists who basically ushered in the marginal revolution. And his students were Friedrich von Wieser, Eugen von Böhm-Bawerk. Those were the second generation Austrians. And then their students, including Ludwig von Mises, the third generation Austrians, were the ones who really popularized Austrian economics, started bringing a lot of the monetary focus into Austrian economics. And they're the ones who obviously have been responsible for a lot of the popularization of Austrian economics in the mainstream and in the United States. So Menger, but Menger, had his own monetary contributions. He wrote On the Origins of Money, one of his first monetary pieces, a very short piece, but he also was involved in the Austro-Hungarian monetary reform in the 1890s. And our website, mengercenter.org, is available on the web, and that basically, we named it after Menger to show that we're firmly within the Austrian tradition, and to try to get a little more understanding of him among economists and among the general public, because he's kind of, even though he's the founder of the Austrian school, he's very often forgotten, and a lot of his works are still in German, not translated into English. So a lot of his ideas still need to be brought out into the general public.
Well, good. Today we are going to be talking a little bit about the current status of our Federal Reserve as well as central banking per se. But what was Menger's position on central banking? Did they talk about central banking and think of central banking as we do today? Or how did they look at that? I remember personally Murray Rothbard and others, and we knew their position on central banking, and they were so strongly opposed. But what was the attitude of central banking in the time of Menger?
Well, at the time of Menger, so you read some of his stuff, and he's a little more, I wouldn't say necessarily definitely not open to the idea of central banking as it exists today, as the kind of this super lender of last resort that's just purchasing assets and trying to prop up the economy. He was definitely, because he was involved in the Austro-Hungarian monetary reform, he did see a slight role for government in the issuance of money. They were definitely not, he would not have favored the complete centralization. What we have today with government completely monopolizing the issuance of money, I don't think what he would have supported. He saw money as essentially a social institution, something that came about due to the market needing some sort of medium of exchange. He recognized the fact that governments had kind of jumped in and provided money, and so one of his goals was to make sure that the government provided a sound money, a stable currency, something that could be relied on. He lived, so his marginal revolution work was kind of in the 1870s, and he really didn't do a whole bunch of writing after about I think it's either 1904 or 1908. He was starting to get old. He died in the early 1920s. If he had seen, what the Federal Reserve ended up doing in the 1920s, what happened during the Great Depression, I have no doubt that had he lived another 10 or 20 years, he would have been just as strong against central banking as Mises and Rothbard ended up being.
Well, from my viewpoint, I think central banking is under the gun. Our Federal Reserve is under the gun. They're between the rock and the hard place. They don't know which way to go. And every time they come up with an announcement, everybody's on pins and needles, and the announcements can mean the difference of not a couple billion, but even trillions of dollars on which way it goes. We saw that last week, an announcement in the market, went down sharply on Friday due to the fact that the Fed didn't act and didn't raise rates. So what would they have done if they had raised rates? It could have been, right, even a lot lot worse. So they are now, struggling. Even this morning, the markets went down initially. I don't know whether they'll stay down or not, because the Bank of Japan, after they've been in trouble for 20 or 30 years, the Bank of Japan announced that they may go back and do some more QE. So tell me a little bit how you see the status, first of our Federal Reserve. Yeah, you and I work so closely on trying to bring the attention to the American people about just getting an audit the Fed. And a lot of people know about the Fed now, but I think currently the Fed is getting a lot of negative publicity, and it's all deserved.
Yes, definitely. I mean, they've got a $4.5 trillion balance sheet. We keep talking about wanting to raise rates, wanting to reduce the size of the balance sheet, but this has been, 8 years now that we've had basically zero interest rates. The federal funds rate has been close to zero. 8 years of a huge and ever-increasing balance sheet. It's not going to happen overnight, even if they end up being serious about this. I think Yellen a couple meetings ago said something about, well, we don't expect to get back to full policy normalization until the end of the decade. That's at least another 5 years, if they even decide to do this. And when you hear Yellen say, last week at the press conference, she said, well, we're still waiting on these rate hikes. We want to see a little more improvement in the labor market. We want to see a little higher inflation. They keep expecting this wonderful recovery with 4% GDP growth and an unemployment rate that gets down to 4% and inflation, shooting up to 2%. What they don't realize is that we still have not had a liquidation of all the malinvestment from the last bubble. And so prices really want to go down, but the Fed is trying to prop them up. And they're trying to prop up this thing that doesn't want to rise. I'm not sure that they will ever get to a point where they're going to say, well, we feel completely comfortable that the economy's recovered, and they may start raising rates a little bit, move them up to 0.5% or 0.75%, or maybe even 1%. I'm not sure that we'll ever get back to the 3 or 5% that we saw, a decade ago. But the balance sheet, I don't think it's ever going to, I'd be shocked if it ever starts decreasing. I think before they get to the point of full normalization, as they call it, and reducing the size of the balance sheet, I think we'll probably have another bubble bursting, and the Fed is going to start doing QE4. They're going to start more asset purchases. But you can only go so long. I mean, even with the Bank of Japan, there's only so many assets that these central banks can buy, and at some point, there's nothing left for them to buy, and these policies will have to come to an end, and that's when the ultimate crash will come.
They know the interest rate should be higher. This is abnormal, and everybody agrees. The interest rate should be higher. But they also know that there's a price to pay under current conditions, that if they raise rates, it's going to be very serious. But they don't really talk about the consequence. They think that it's either the status quo or raise the rates and suffer a consequence. But when you don't raise the rates and you pretend that they can do it later on, all it does is, from my viewpoint, is delay and actually sets the stage. They've been doing it for all these years, so the bubbles are bigger. The bond purchases are bigger and the debt is more. So I think they're at a point where they're losing credibility, but let's hope maybe that they'll lose total credibility. And do you see it that way? Do you think their credibility is really on the line right now?
Oh, I think it is. I mean, I think most traders and most economists are kind of scratching their heads, wondering if these people know what they're doing. So many people say, okay, it's been 8 years, we need to start raising rates again. You are setting the stage for a much larger bubble. This next crash is going to make 2008 look like child's play.
Right.
It will be very, very bad, and partially due also because we still have not fully liquidated all the malinvestments from the last crisis. We still have a lot of bad debts out there. We have people in mortgages that they barely can pay off. We still have people who are looking for jobs. They were laid off during the last financial crisis and still have not fully adjusted to the kind of new normal that we have right now. A lot of people have dropped out of the labor market. I think things are going to be really, really bad in the near future.
They talk about the goals and the purpose and the function of the Federal Reserve and, stable prices and high employment. But you know, in the last good many years, maybe getting close to 20 years, the function of the Federal Reserve seems to me to be to prop up the stock market, and that actually started in 1987 with the found of this President's Working Group on Financial Market, which is called the Plunge Protection Team, and the Fed leads the charge on there. It's always prices. But you know, this morning on CNBC, Bullard from St. Louis was on there, and he was critical of Jim Cramer for being a cheerleader, you know, for the stock market. Well, here's a Fed official who is part of the system that does it, is criticizing somebody who's always cheerleading. They always, you know, want these higher prices. So they've been directing their attention to the stock market. At the same time, the average person is getting poorer and nobody earns any interest if they save money. So does it appear, or is it an absolute policy, do you think, that the whole purpose of the Fed in this past decade is to try to keep stock prices up?
You know, the stock markets are, you know, every time you see the Dow drop 200, 300 points, people start to freak out and panic, and they think, oh, you know, the bottom's going to fall out. Or if it goes down 500 or 1,000, you know, then people really, really start to panic. So I think that, you know, they definitely are trying to boost stock prices. They are definitely trying to, you know, help the big banks. I mean, one of the reasons they have this $4.5 trillion balance sheet, I mean, is to you know, you have these huge amounts of excess reserves because they purchased all these assets, taken all these basically bad debts, bad mortgage-backed securities off the books of J.P. Morgan and Goldman Sachs, and they're holding them, and then the excess reserves are held by these big banks, and they pay them right now 0.25% interest. And as the Fed begins to start raising the federal funds rate, they will also start to raise the interest rate that they're paying to these big banks on their excess reserves. So the banks are basically kind of winners regardless, and it's the rest of us who start to see the price of beef rising, or the price of milk, or the price of eggs. Rents, you know, apartment rents are skyrocketing. They're increasing at unprecedented rates right now. So the cost of living, you know, us small people, we're getting squeezed, and the big banks are literally laughing all the way to the bank.
Yeah, and the average person is suffering from price inflation, and yet they say the CPI. But the other thing they don't recognize is maybe they'd like to see some of this money being spent differently and devalue the currency faster to lower the real debt. But they get very frustrated with that. But the debt does, the inflation of the money supply and the zero interest rates does play an important role in the accumulation of debt in the various areas. So why don't you speak to that for a minute? What kind of debt accumulation have we had, public and private, that we ought to be concerned about?
Well, we should definitely be concerned, number one, because you still had a lot of that debt that was not liquidated during the last bubble bursting. And then you're piling more on top of that, because when you have such low interest rates, you're incentivizing people to continue taking on debts that they are not going to be able to afford 5 and 10 years down the road. And mortgage applications are up, car loan applications are up, credit card debt is starting to increase again. And now, you know, after 8 years, you know, when you first started the zero interest rate policy, people are thinking, well, okay, maybe it's only going to last 2 or 3 years, and they're going to maybe be conservative. Now that we're at 8 years, now that the Fed has once again kicked the can down the road and said, well, we're not going to hike interest rates this time, people are still trying to think, well, maybe I'll, you know, apply for that mortgage and try to get a fixed rate while rates are still low. And they're going to try to, you know, now take advantage of these low rates and get themselves into something that's completely unsustainable. So the private debt is, and I read too somewhere, I think that adjustable rate mortgages are back. So these rates that adjust based on the interest rates, well, people are, if they're getting into those and rates start rising, they're going to start getting squeezed. And then, of course, we have the government that is, you know, still running a whole bunch of deficits every year. And the Fed loves that because that's what allows them to continue engaging in monetary policy. They're basically indirectly monetizing a lot of this debt. The government sells it to the big Wall Street banks, the primary dealers, and the Fed buys it from the primary dealers. And so the government gets a market for its debt, and the Fed gets more securities to put on their balance sheet, and the cycle's just going to keep going until it bursts again.
There was another thing that Jim Bullard said today, you know, the president from St. Louis. He said that he would have voted to raise interest rates last week, but he's not a voting member right now. But the person who did vote against it, this Jeffrey Lacker, from Richmond. Do you know anything about him that would suggest that, has he been doing this before, or is this the first time he's dissented like this?
I can't remember because it's been a few years since he was on the FOMC. I want to say that he probably dissented from some of the stuff the last time he was on board, but I remember when I was working for you on the Hill, we had some Richmond Fed economists come up and talk to financial services staffers, and we went up and talked to them afterwards, and they, even though they weren't completely on board, obviously, with Austrian economics, and I wouldn't even say they were necessarily sympathetic to, anything sound economics-wise, they at least understood where Austrians were coming from, and they were somewhat sympathetic to some of our views. They seem to be fairly understanding of some of the problems that were happening. Of course, this was 3 years ago. I think nowadays they would definitely see some of the warning signs. So I think Lacker is getting some good information. He's got some good people advising him. Obviously not fully on board with Austrianism, but definitely kind of a sympathizer, and he understands the problems with this continued zero interest rate policy. So I would definitely see him as somebody who will continue to dissent in the future. He had a speech a couple weeks ago where he said, yeah, it's definitely way past time to raise rates and they need to start rising.
The other day when they asked me about this, the point that that Hayek makes about the pretense of knowledge comes across, because there's a bunch of guys getting together and women to get together in a secret room and they actually, sort of convince themselves that, we know what the proper rate of interest would be. Not ever taken into consideration, and the interest rates is, to have a sound economy, you have to have a market rate, or the whole thing goes nuts. Everybody does. Right. Everybody that makes mistakes, and the price of money is involved in every transaction. So that simple principle, I guess, in the early years of central banking, they weren't nearly as involved in this, and in some way this may play into our scenario of wanting to challenge central banking because it isn't working. But to me, it's really amazing that they actually believe that they know what the proper rate of interest ought to be.
Well, I think they forget, and a lot of people don't understand, that this interest rate fixing is essentially a price control. And I mean, we know what would happen if the government were to set the price of oil, or set the price of housing, or set the price of milk. We know and we understand what kind of negative effects that would have, but there's kind of a blind spot there among most academic economists and mainstream economists, in large part because a lot of them are captured by the Fed and paid by the Fed. But they don't seem to see this and understand that it's price fixing. And when this is basically the price of money, and the price of credit, and the price of loanable funds. These are, and money is one half of every economic transaction. It's what undergirds society. It's what causes civilization to be able to exist. It's what allows people to plan for the future. And when you get that fundamental price messed up because 12 people are meeting in Washington and setting that price and setting it at a rate that has no correlation to any sort of market fundamentals or market dynamics, you're going to have introduce a whole bunch of shocks into the economy, and that's what causes this malinvestment. So you basically everything undergirding the economy is messed up because you've got these 12 people thinking that they can set this price.
The Keynesians sort of like debt. There's no fear at all about debt. We worry about debt. And the debt is built in, and it compensates for not paying interest because in checking with some prices are a little bit higher if you have no interest rates for 5 years. And if they check it out, it's really built into the system. But people get to the point where they buy stuff they don't need when there's zero rates, and then it's just paying back principal that becomes the problem. The other day, somebody asked me from an Austrian viewpoint, what would the Austrians do? And under these circumstances, if we were in the Fed, they couldn't quite comprehend that the Austrians are not forced to pick a rate of up or down. Now, we are running close to that. So give me a brief answer to that about what an Austrian how an Austrian should answer that question, because it's a question that there is no answer. We can't say, oh no, stand pat, or go ahead and raise interest rates.
Yeah, I mean, the thing that the Austrians should recommend is just for the Fed to get out of the whole business of setting interest rates to begin with. And I think once that happened, I think you might have a small shock at the beginning where people say, oh, well, now they no longer have access to this federal funds rate, this low federal funds rate. But then the banks are basically going to be able to set their own interest rates, how much they charge in loaning money to other banks. You still have problems, obviously, because you have fractional reserve banks, and that's a system that's propped up and subsidized through deposit insurance. So there'll still be instabilities in the banking system. But without that price fixing, you're going to get back to a market rate of interest where if a bank is unsound, they're not going to be able to go to the Fed or go to these other banks and borrow in the overnight market at near 0%. They might have to pay a real penalty rate of 3 or 4 or 5%, or if they're in really bad shape, maybe 8 or 10%. And if the bank is really in bad shape, they'll go under, and their assets will be and debts will be liquidated and passed on to other banks, and you end up with a stronger financial system as a result.
Paul-Martin, I want to thank you very much for being with us today. This is an interesting subject, and you've worked on it for a long time. I'm hoping this would be beginning the end, but I appreciate very much you being with us today.
Well, thank you very much, Dr. Paul, for having me on.
Okay, and I want to thank all the viewers today for tuning in, and please come back to the Liberty Report soon.